The Bollinger Band is a volatility-based indicator. Therefore, to understand it, we must first understand the concept of volatility. In simple terms, volatility can be defined as the speed at which the price moves. The price does not move at a constant speed. We have low volatility and high volatility environments. In a low volatility environment, the price takes a long time to cover a certain price distance. We see small price swings that move in an unorganized manner. We have red or green candles with no real momentum. Low volatility environments are often known as sideways or range-bound markets. During such times, it can be very difficult to trade because the price does not move much. However, the price movement is organized and predictable to a certain extent. Therefore, small and calculated trades can be taken in such conditions. On the other hand, we have high volatility environments. During such times, the price moves in a quick and rapid manner, creating large price swings and big candles. Such moves have a lot of momentum. High volatility environments are often referred to as trending markets. During such times, it can be easy to trade. However, the entries and exits must be aggressive in such markets because the price can go wild in any direction. Therefore, in a low volatility environment, you should be a conservative trader. And in a high volatility environment, you should be an aggressive trader. But how do you identify the volatility? This is where the Bollinger Bands come in. The Bollinger Bands indicator is designed to help identify the market volatility with ease. It consists of 3 lines. Its default setting is set to 20 periods and 2 standard deviations. On these settings, the middle line is a simple 20-period moving average. The upper band is calculated by adding 2 standard deviations to the middle line. Similarly, the lower band is calculated by subtracting 2 standard deviations from the middle line. During low volatility, we see that the bands become extremely narrow, and the price moves sideways inside them. The price keeps on bouncing from the upper band to the lower band. As you can see, the price stays within the bands most of the time. When the price closes above the upper band, it immediately reverses downwards. Similarly, when the price closes below the lower band, it immediately reverses upwards. During high volatility, the bands go wide, and the price moves extremely near the upper or lower band. In an up move, the price will stay near and around the upper band. The price may close a few candles above it without reversing. Similarly, in a down move, the price will stay near and around the lower band. A few candles can close below it without any reversal. Therefore, the Bollinger Band gives us a clear idea of volatility. If you follow a trend trading strategy, then you should avoid placing trades when the Bollinger Bands are narrow. You should only trade when the Bollinger Bands are wide. If you want to trade reversals, then you should avoid trading when the Bollinger Bands are wide. You should only trade when they are narrow. With that being said, you cannot trade blindly based on the size of the bands. You need a strategy with a good set of rules to trade. Setup 1. Breakouts. A breakout is a point where the price breaks out of a sideways market and transitions into a trend. If you can enter at the right moment, you can capture a significant move with a very tight stop loss. The Bollinger Bands can help us identify the right time to enter these breakouts. We first need to identify a sideways market. To do that, we will look for areas on the chart where the Bollinger Bands were relatively narrow. We also want the price to move sideways during that time. Once we identify such a market, we need to ensure that the price has stayed inside the bands for most of the sideways range. The upper boundary has provided resistance to the price. Similarly, the lower boundary has provided support to the price. Now we wait for the price to break out of the Bollinger Bands. On this candle, we see that the price creates a solid green candle that breaks and closes above the upper band. As we discussed earlier, the price will generally move inside the Bollinger Bands. So, a breakout like this signals a strong force in the market. Therefore, this is a valid breakout setup. Here is a bearish breakout. Here we spot a tight sideways range. We see that the bands were squeezed and very narrow. The candles moved sideways and remained inside this tight range for a long time. The upper band provided resistance to the price. Similarly, the lower band provided support to the price. So, we identify this as a tight range. We wait for the price to break above or below this range. On this candle, the price breaks and closes below the range. It is a large red candle with a strong close. So, this is a valid breakout setup. Setup 2. Reversal setup. Bollinger Bands can be used to trade reversals with high probability. As we discussed previously, the price will remain inside the Bollinger Bands for most of the time. Therefore, whenever the price breaks or touches the upper or lower band, we can expect a reversal. Let's first understand the sell setup. Here we see that the price was in a sideways range, trading inside the bands. The upper and lower bands held the price inside them. On this candle, the price touched the upper band and immediately reversed. Then it went down to the lower band. The price once again touched the upper band here and reversed immediately. This time, as well, the price goes on to touch the lower band. Here is a bullish reversal setup. Here we see that the price touches the lower band on this candle and it immediately reverses and moves upward. The price goes on to touch the upper band here. So we can say that the reversal setups also work well. Setup 3. Pullbacks. Pullbacks on Bollinger Bands are one of the simplest setups. To trade pullbacks on the trend, we first need to determine the trend of the markets. When the price is moving within the upper and the middle band, we consider the price to be in an uptrend. In an uptrend like this, we will look for buying opportunities at pullbacks. The price usually pulls back to the middle band, so we will look to buy here. Similarly, if the price is trading between the middle band and lower band, we consider this a downtrend. In a downtrend like this, we will look for selling opportunities at pullbacks. These pullbacks happen at the middle band, so we will look to sell around the middle band. So, these are the three key setups using the Bollinger Bands. If you want to trade based on these setups, you must add other confluences to identify high probability trade setups. These confluences can be support and resistance, candlestick patterns, trend lines, etc.